Welcome to the InfoWell podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso, and today we interviewed Fernando Angelucci, CEO of SSSE, with over $250 million in self-storage assets across 24 different states. Anthony, what was the takeaway or two you had?
It's very interesting. First takeaway is what he talked about at the beginning. You know, Cameron, I know you always like to know about the man behind the company and wanted to get his history. And what he did, something which many people do, at least the first part, is they read Rich Dad, Poor Dad. But what he did different, he actually put it into action.
Yeah.
So what I want to encourage people listening here, a lot of you want to create that passive income more than your monthly expenses. You can't get there unless you take action. And I'm not saying this podcast or this investment is the one for you, but you do need to find that. And we're going to do some more details information, but we've created this passive income lab that can kind of help you go through and find those opportunities that are for you. So I would encourage you to take action. Also, this is the first one I think we've had really on self-storage.
Yeah.
And we're starting, if you notice, having some more content, more on these investments and ways for you to create passive income. And self-storage, I think, is a very unique asset class. It's not tied so much to the stock market. It's often called recession-resistant. And I think it's a very steady asset class. So I'm glad that we had them on here so our clients and Cameron can learn more about self-storage. Cam, what was some takeaways you had?
Well, I think I heard your takeaway was to take action. If I had a takeaway, it would be to find options, right? And that was one of the things I appreciated about Fernando's opportunity here and what he's doing is that he came in and he gave us two options for potential investments. One is you can invest in a fund or you can invest some of his opportunities on an individual level. And he went through the three pillars of his business. One, consolidation. The second is kind of adaptive reuse. And then the third is kind of ground up. So I won't go into detail on what those are. I'll let Fernando do it on the podcast, but I appreciated the options that are available under his umbrella. So hope you guys enjoy this episode with Fernando and enjoy his story on how he went from an engineer to self-storage mogul. Enjoy this episode. If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad, Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christiansen, along with our co-host Anthony Faso, and today's guest is Fernando Angelucci, CEO of SSSE, with over $250 million in self-storage assets across 24 different states. And he went from engineer to self-storage mogul. His story is wild. We can't wait to dive into it. Fernando, how are you today?
Doing well. Thanks for having me on the show.
Absolutely, man. So let's tell our listeners, man, how did you go from being an engineer to becoming a full-time real estate investor and the self-storage mogul that you are now?
Yeah, interesting story. So I'm the son of two immigrants. All immigrants out there listening probably know the agenda. You go to school, get good grades, go work at a Fortune 50 company, and then retire with a pension. Mm-hmm. Unfortunately for my parents, when I was 16, I read a book called Rich Dad, Poor Dad, and it changed the way that I thought about wealth building and just time freedom. So still had to go get my engineering degree, or else, my parents would have killed me on the spot. And as soon as I got out, I immediately started flipping houses. So not only flipping houses, but flipping contracts. Very quickly, I was able to replace my W-2 income. So within 13 months of working at a Fortune 50 company, I quit to start real estate investing full time. So that's when the first part of my journey started. And then very quickly, I realized that, tenants are not all they're chalked up to be. Habitation-based real estate's a lot harder than you think. And so I was sitting down one day and I realized that all of my stress came from kind of the three T's: tenants, toilets, trash. So how was I able to, keep on getting the advantages of investing in real estate, right? Leverage, depreciation, cash flow, but not have to deal with these three T's. And one of the only asset classes that came out of my research was self-storage. So from 2016 to 2018, we sold almost all 70 of our habitation-based real estate. So houses, small apartment buildings, large apartment buildings. And then we started wholesaling self-storage. So the reason we do wholesale first is because it allows us to test the market without a lot of risk. So if I'm able to get a property under contract and then assign those purchase contract rights to someone that is way more experienced than me at a higher price than I was able to get them under contract for, that must mean I'm doing something right. My underwriting is good. And so then once we kind of got our feet on the ground with the self-storage market, then in 2018, we bought our first asset just outside the Chicago land area. Very small, less than 17,000 square feet. It was about $1 million. And then once I kind of got the hang of how to operate these things, we just started going gangbusters. Very quickly ran out of my own money and then started bringing in investor cash. And then since then, we just closed on the land for our 54th deal, 24th state. We just crossed over 900 passive investors. So super grateful and excited to see what the future brings.
Fernando, most of our audience, I mean, they're kind of getting tired of some of the options that they're getting fed in Wall Street. Why should self-storage be on their radar?
Yeah, this is great. I was actually having a conversation with my father today. When you look at the S&P 500 or just in general, the general basket of goods or basket of equities in the public markets right now, the PE ratios are obscene. I mean, the fact that now it is considered normal to invest into a company that will take 40 years to pay back your initial investment, 40 PE, that's wild. And yes, public equities allow you to have liquidity, but they don't let you kind of take advantage of some of the other great things that come with real estate, which is leverage and depreciation. And now recently a new tax bill was passed that brought 100% bonus depreciation back. So for example, now I have some investments where not only that investment will, make above 20% internal rate of return for my investors, but year one of the asset operating, they get to write off anywhere between 60 and 90 cents per dollar invested in bonus depreciation against their other K1 income, or if you're a real estate professional, against your active income.
Nice. Fernando, I know you can talk about self-storage as one of the most recession-resistant and scalable asset classes. Why haven't more people caught on to that yet?
So it's funny, people have caught on. So back in the day, call it maybe even less than a decade ago, we were able to buy self-storage facilities at double-digit cap rates, 10, 12, 14% unleveraged return on an asset. Then all of a sudden self-storage was picked up by the money magazines of the world, Fortune, et cetera. And then we saw this large migration of institutional capital coming into the market. So that may seem like it's scary, but we're still in the infancy of this asset class. Multifamily housing has been around for thousands of years. Single family houses probably been longer than that. And self-storage has really been an asset class that has been serious for the last maybe 60 years. If you look at Public Storage when they started, back out in the West Coast. But that being said, the market is still not saturated at all compared to, say, like multifamily, where, the top institutional operators own a majority of the investment grade stock in the United States. In self-storage, the top 6 publicly traded institutions that are backed by, the Bill Gates and Blackstones of the world, they own about 20% of the entire self-storage stock in the nation. The next 100 largest operators below them own another 10%. So there's still 70% of the self-storage facilities in the United States are owned by mom and pop operators. They own 2 or fewer facilities, and there is a massive opportunity probably for the next 2 to 3 decades of consolidating and rolling up these mom and pop facilities, especially because a lot of these sellers now are of retirement age, or maybe they're on their second or even third retirement. So a lot of opportunities, still not saturated. We've even seen that pre and post COVID. So, pre-COVID, 1 in 11 in the United States use self-storage. Now it's 1 in 9 use self-storage, and that number is continuing to increase. And there's a few reasons for that. You look at the largest generations out there. You have the baby boomers, where on the front end of the baby boomers, you have a lot of them going into retirement communities, active living communities, assisted living communities, and they're having to downsize from these 5-bedroom ranch properties into a 1 or 2 bedroom townhome or a condo. And they're the generation that they saw the traumas of, the Great Depression. So they hoard things because you never know when you're going to need this bent spoon to use, the magic situation. So that's kind of the front end. On the back end, you have a lot of the younger baby boomers that are retiring in mass. Something like 15 to 16,000 people a day are retiring. These are empty nesters. And most of their net worth is trapped in their primary residence. So now that they don't have a source of income, they may have to look at downsizing to capture some of that equity that's stuck in their house. Then you look at the other side of the generational divide, the millennials and younger, and they are having a massive affordability problem. So they did not have the benefit of buying $100,000 houses, and getting a sub 3% mortgage. So what are they doing? They're opting for these more walkable and livable communities, places where they potentially don't need a car. And instead of getting the 5-bedroom, 2,500 square foot ranch, they're getting a 2, maybe a 3-bedroom condo in the city. And they're using self-storage almost as an external closet, as additional square footage, because to buy that additional bedroom or to rent that additional bedroom is way more expensive than just renting a 10 by 10 or a 10 by 20 unit at a self-storage facility.
Interesting. So, Fernando, can you share with our listeners what is it exactly that you guys do, and how is it different than some of your peers?
Yeah, so we are a self-storage syndicator, sponsor, and developer. We allow investors to come alongside us. We do a couple things that are a little bit different than everybody else. So first thing is that we pass 100% of our bonus depreciation onto our investors, whatever is the maximum allowed by the IRS. So that is why we're able to get these massive depreciation numbers per dollar invested, because of the power of leverage, right? So let's say I have a $10 million build or a $15 million build that I'm doing. That entire project allows me to pull $2.5 to $3 million in year one depreciation, but I only have to raise, let's say, $3 million or $3.5 million in equity. All of that bonus depreciation, that $2.5-3 million in bonus depreciation, goes towards that $3 million in shares. So that allows you to get a kind of outsized equity return. Whereas most general partners, they usually either keep all the bonus depreciation for themselves, or they take an outsized portion of that bonus depreciation. Another thing that we do is we just launched a new fund, and that fund allows you basically to sit right next to us inside of our entire business. It's a GP fund. So not only do you get access to the GP economics that we get, fee-based income, developer-based income, asset management-based income, but then it also allows you to participate in other parts of our business that most of the time sponsors do not allow. So the profits from our wholesale activities, for example, wholesaling is extremely lucrative. You can tie up $1 million facility for $10,000, assign that contract for a $200,000 return, and that transaction takes 6 to 8 weeks. So that's a massive, the IRRs are ridiculous, thousands of percent. So this is something that is usually not available to passive investors. And then you also get access to, because have a wholesaling operation, that means we get to vet deals that we sell to a vetted buyer list. And on that buyer list, sometimes they need, bridge financing or bridge pref equity. So they say, hey, Fernando, you're already selling us the deal. You've already underwritten the deal. Why don't you take a 6-month note in the first position at 50% loan to cost? Or why don't you take some preferred equity above our first position note that will pay off when we refinance in 6 to 12 months? So that is also extremely lucrative. They're short term, they're very cash heavy, and it allows our investors to capture some of that profitability without having to have capital, just locked up. But, when you invest in one single asset, that one asset usually takes a while to return any type of distributions. So not only do you get access to not only our ground up developments, which have very high bonus depreciation, you get access to our, light value add products that produce cash flow in the medium term, 6 to 12 months after investment. And then you have access to the kind of the immediate cash flow, which would be that, first position debt, pref equity, and wholesale proceeds.
Fernando, you mentioned kind of the opportunities there. What kind of investor is a good fit for this, and who isn't a good fit for?
Yeah, so we have kind of two segmentations of our list. So we have our accredited investors, which are going to be, there's 20 different ways that you could be accredited, but the two main ones that people use are either $1 million net worth, excluding the value of your primary residence, or if you're single or married, $200,000 or $300,000 income for the last 2 years in a row. So that's our accredited investor, our 506B style deal, our 506C style deals. We also do kind of our friends and family raises, which allow us to bring up to 35 non-accredited. However, they have to be sophisticated investors into some of these smaller deals that we're only raising, let's say less than $1 million.
Fernando, how do they define sophisticated investor?
This is a great question. The SEC is extremely vague in the way they write their guidelines. And I think that allows them, they do this intentionally to allow them to prosecute when they want to, throw the book at people. So typically what I say is if you are someone that has other passive investments, if you are someone that has real estate investments, you work in the finance industries, these are all things that I would consider sophistication. Again, I'm not a professional, I'm not a CPA or an attorney, so always consult with your counsel first. But that's usually what I see as considered sophisticated.
Awesome.
What are some common misconceptions of this space and self-storage?
Yeah. So, the first one, which you guys kind of touched on, is a lot of people say it's counter-cyclical, which means that it doesn't do well when the market's doing well, and it does great when the market isn't. And that's not true. We are truly, like Cameron said, recession resistant. But we do really well when the economy is doing well. Why? So when people are earning a lot of money and they're flush, they start buying things. And if the property market isn't conducive for them to upscale in their, their housing space, they usually put those new things or the old things that they're replacing into storage. But, when things are not going great, self-storage is a business that helps people in transition. So if you are downsizing, if you are moving locations to get a new job, these are all things, death, divorce, anything that is someone in transition, we do very well. So that's one of the ones that I always kind of point out. It's not counter-cyclical. It is just recession resistant. The second thing that I hear all the time, and it's from people that don't really understand our space, is that they say, I see self-storage facilities everywhere. Your industry must be completely saturated. And they say, okay, well, where is it saturated? You can't say the United States as a whole is saturated. You can't say that, Illinois or California is saturated. You can't even say that a city like Chicago or LA is saturated. You can't even say that a neighborhood is saturated, because self-storage is such a hyper local investment. Think about it. So over 67% of our tenant base are going to come from a 5 to a 10-minute drive time. And that kind of makes sense when you put yourself in the shoes of a self-storage user, a customer. Usually you don't want to go too far away from home. Usually you don't want to go too far away from work. You want to be able to swing by on your commute to pick something up, drop something off. So you're not going to drive across town or to another town to save $5-10 on your rent. So it's extremely hyper localized. So that's why I always ask, okay, if you think it's saturated, what 3 to 5 mile radius or what 5 to 15 minute drive time radius are you specifically talking about? And then they usually don't know how to answer that.
Fernando, do you mind walking us through maybe a current deal that you've got or a past deal? And then also on the front end of that is, if someone is considering self-storage as an opportunity, what should be they looking for when they're evaluating the opportunity?
Yeah, absolutely. So I'll touch on kind of that side first before I go into some of the previous deals or current deals that we have. If you're going to be an active operator, you need to make sure that you're bringing in third parties that have more experience than you. So especially if it's your first deal. So don't just rely on your own underwriting. There's this whole, symptom of rosy colored glasses. And all of a sudden, red flag starts looking like pink flags start looking like white flags, just because you want the deal to work. So you're going to, look with other directions when you see things that don't really align with your expectations on that deal. So it's very important to, not only have your lender involved in the underwriting, but then also hire a third-party feasibility consultant. These people are paid up front, so your payment has no effect on their results. After the payment is through, it takes them, a couple weeks, and they come back with a huge report, usually 100 to 200 pages, explaining why your project is either good or not good, where are the challenges, how can you mitigate those challenges, or in some cases they say just don't build or buy this asset. This is just not going to work out well for you or your investors. So if you're an active operator, make sure that you're relying on third-party feasibility. And then same thing with operations. If you have a facility that's large enough to support it, there are companies out there, all the big names that you've heard of, that will manage that facility for you. CubeSmart, Extra Space, Public Storage. These are publicly traded companies. Their whole business is self-storage management. So if you think you know something that they don't, you're wrong. They have been doing this for decades, and they have perfected these things, these operations of these facilities down to the granular level. So make sure that you're getting good third-party help.
Fernando, I've seen the public storage all over. So you telling me that that might be owned by a third party, and they're just they're just a management company?
Correct. Yeah, correct. So the larger self-storage operators and managers out there, they require you to put their flag on the building. So just like in hotels, when you see a
Marriott,
a Hilton,
sometimes.
a Marriott, most of the time that is not a corporate owned hotel. That is owned by a third party, and the flag is just the manager that's on that building. You're taking advantage of their brand awareness, their brand presence, and their expertise in the market. So that's the same thing in self-storage. Public Storage, Extra Space, CubeSmart, U-Haul, they have their own corporate-owned stores, but they also do a ton of management. It's one of their biggest growing sectors of their businesses. So yeah, that is the case.
Love it. Awesome. Mind walking us through a current or past deal?
Yeah. So we have kind of three pillars of our business. The first is our consolidation part of our business, where we buy, mom and pop owned facilities. They're typically smaller, typically are not state-of-the-art facilities like you see nowadays going up. These are ripe for value add. So, half of the time that mom and pop owner is the one sitting behind the desk. They are the one that the tenants talk to every day. And then what happens? Naturally you become friends with your tenants. You start letting them slide if they don't make payments. You don't charge any late fees. You don't charge any lien fees. So that is one of the issues. The second thing is that their expense loads are super high. So, because it's the owner, maybe they have a $500 a month cable and internet package because they want to watch TV when there's no tenants in there. That's all going to the bottom line, and that's affecting their NOI in a negative manner. Sometimes they overstaff these facilities because they are not utilizing, proper technology to help them run more efficiently. So for a small facility, they may have 2 or 3 full-time employees, when you can usually run these things either unmanned or half of one person, or depending on the size, if it isn't much larger, you can run them with just one full-time person. So in our industry, the 2 largest expenses are labor and then property taxes. So on the property tax side as well, a lot of these mom and pop operators don't know that they can contest their taxes. They can fight the county or the municipality to lower their property taxes if they're being, improperly built. Then on the flip side is the revenue management side. So sometimes, or most of the time, what we see is these mom and pop operators are not keeping up with market rents. They kind of have this rule of whatever your rent was when you first showed up, that's kind of what it will be for life until you move out. Whereas what we use is some of these very sophisticated tech stacks. They even use AI, where they will check all of the competitor pricing on a 5 to 10 minute increment and adjust our pricing. They will check how often a keyword in Google is being typed in. If we see a large spike for self-storage in Lawrenceville, Georgia, and you see a lot of people searching for that, then it will automatically raise our online prices. It will also help us with existing customer rent increases. So for example, this software will go through our entire rent roll and say, we'll score all of your customers from a 1 to a 10, maybe 1 to 3s, you don't raise the rent at all. 4 to 7, you raise the rent a little bit, maybe 10, $15. And then 8 to 10, these are the guys that they have their payments on auto pay with a Amex Platinum card. Their social media profiles show that they're traveling around the world. Most likely they're willing to absorb a larger rent increase, 20, 30, 40%, and really not even, there's no peeps about it. They don't complain. So these are some of the things that a lot of these mom and pop operators are not doing, which allows for great value add opportunities for people like us. So that's kind of the first leg, where we buy these mom and pops and then we consolidate them into portfolios of 10 to 15 properties and sell them off. The second leg is our adaptive reuse leg, which is, we find big box retail stores, Kmart's, Walmart's, things that aren't self-storage, and then turn them into self-storage, because these locations are typically in great locations. So let's say Sears buildings. Sears used to be a huge company. They were always on kind of Main and Main. They were in shopping mall complexes. They were surrounded by dense residential, super high traffic counts. These are all the things we want to see for self-storage. So why build from the ground up when we can buy an existing shell and put storage inside that not only drops our timeline of construction, but it also drops our total construction cost on a per square foot basis. So that's, leg 2 of the stool. And then leg 3 is our ground up developments. These are our Class A kind of flagship, state-of-the-art REIT grade facilities. 2-3 stories, 100,000, 120,000 square feet. These are the ones that we sell one off to the publicly traded companies. This is what they want. Because they are REITs, they typically don't like to take development risk. They'd rather wait for you to build the property and then buy it off of you at some, either as early as certificate of occupancy or as late as full stabilization. And that's where you're going to get these large pops in valuation.
Now, are these, like you mentioned, these 3 pillars? Are they 3 different investments, or is there one investment where you have all 3 pillars?
Yeah, so we have kind of both options. So if you're an investor that likes to do due diligence on every deal that you're going to invest in, and you want to say yes or no per deal, you can invest in individual assets. So these are individual asset syndications. But then we also do have our generalized fund, which allows you to spread your investment across all of the deals that we do. So you can have a little bit allocated to, a cash flowing value add, a little bit for adaptive reuse, a little bit for our ground up construction, a little bit to our, our wholesale and our pref equity or our first position debt. So if you're someone that'd rather just kind of set and forget it, you trust in the model, you trust in the sponsor, it's better to do a fund investment, because then you get diversification across all of the deals they're doing, versus if you're someone that just likes to underwrite every individual deal, you maybe have a little bit more cash. Then what you could do is it choose the deals that you want to invest in. Maybe you're someone that wants to focus solely on the tax benefits. So maybe the ground up developments are going to be better for you because they produce outsized bonus depreciation. Or maybe you're somebody that's on a fixed income and you're already past retirement age and you don't want to take the gamble on these deals that take 2-3 years for distributions, and you'd rather just do a steady Eddie deal that pays out cash flow day one. Then you have that ability to choose those investments specifically.
If our listeners are one of those investor types that you just kind of characterized, what should they do next? How should they reach out to you?
Yeah, so I always tell people there's kind of 2 ways you can reach out to me. There's one that's a little bit more, say, aggressive, but that's not really the right word. And then there's one that's a little bit more passive. So if you want to, you're listening to this podcast right now and you're like, man, I want to talk to Fernando right now, you can give me a call. This is my cell phone. My cell phone number is 630-408-8090. That's my real number. You can call or text. I will answer. If you're somebody that's kind of a little bit more passive in your outreach, you can go to our website, SSSE.com. All of our track record and all the deals we've done are there. There's an investor portal that you can go into. You can learn more about us. And then there's also a link that you can schedule a phone call with either me or someone else on my team.
Love it, Fernando. We'll make sure that we get both of those in the show notes. And man, I would say direct, right? As far as aggressive, man, if somebody's listening, and you guys want to get a hold of Fernando, man, give him a call today, right? His cell phone's right there for you. So awesome, Fernando. Really appreciate you coming on the show and kind of sharing that information. Thanks again, man.
Thanks, Fernando. Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.